Welcome everyone to Finance with JCL. Hope you're all doing well. And today I'll be going through my portfolio update for the end of May 2021. There'll be two elements to it. There'll be the £1 million investment challenge. And as a reminder, that is a very long-term challenge that I've put on myself. I want to become an investment millionaire through compounding over a period of sort of 30 plus years. Very long term. Got to stick with this with discipline, and let's see how we go. The absolute base return to hit the challenge is 6.66% per year. Now, I could get that via index tracking in all probability. However, I'm really going for that stretch target of 10% per year, because that will require individual stock picks, and that's what I've been trying to learn on and improve on. And the context of the money is every £300 a month going in as a minimum. And I started with a £20,000 portfolio last year. It's kind of a legacy one I've been putting together since 2013, before I was taking it as seriously as I am now. Before we go into detail on that, I'd like to share with you I'm actually on eToro with a public account. You can see the details here on screen. I'm looking to try and get some copy trading done. And the portfolio at the moment is cash in the main. I've just got two stocks in there, and that is Unum Group and Tattooed Chef. There's no other stocks. Sorry, there is one other. It's Aviva, of course. How could I forget? So 3 stocks, and it's a brand new portfolio. I've just started in April, so I'm trying to build it as though I am, starting from scratch, being very selective of what I'm buying, and having a very small number of holdings. That's on eToro. Go and check it out. We've had quite a good start, 2 nice positive months to begin with. So to the investment challenge. And as a refresher from last time, April's update, I need to be at 30,000 or so at the end of this year, and the stretch target is getting towards 32,000. Now in April, my portfolio was worth almost 35,000 for this, and there'll be another 2.5 going in, which leaves me with an estimated year-end position of 37,000. So I'll now share with you where I am as of the end of May. The current value's actually gone up by over 2,000, so it's been a really good month or so. But that's partly because I put more money in, so £1,131 of additional deposits. That's more than the 300. So I've had continued underspend in the budget, mainly due to the COVID lockdowns, essentially being at home more and spending less. And I've also had some investment gains there of almost £1,000, which is a great month. So there's another £2,000 to go in. So the year-end estimated position is 39,000. So that's well ahead of the stretch target, and it is almost 1,800 up from last month. So absolutely delighted with how that's going. So for those of you that like to see things in a picture, here it is in that form. The red line is the minimum return, green line is the stretch target, and you see the black line is comfortably above that. So as long as I'm above the red, I would be satisfied. But ideally, I'll be happy if I stay above the green. I might be ahead now, but realistically, things happen. Portfolios changing value month to month, year to year. So although I'm above the green now, that gives me a bit of leeway in case the portfolio underperforms next year, for example. So a bit more detail for you on what's in the portfolio. First of all, some notable changes in May. I opened 2 new positions in GAN because of I think the long-term prospects of that business are very good with the American market opening up, and also JD.com, which is a great business in China, and I think they're a bit of a price drop down into sort of 70 or so, and I think they're undervalued based on that, so I've opened a position there. Also averaged into Tattooed Chef as their price dropped in the market considerably, and that's been very handy as they've had quite a few good days lately, and also averaged into Alibaba. In terms of how the portfolio is broken down, the individual company's value is 61%. Now it's gone up by 3 percentage points, and that's partly because of the new positions I opened using cash, and also partly because values have gone up. Index tracking is down to 22%. No particular reason for that. It's just the companies have outperformed the index. Same for the the managed fund situation. That's a tenth of the portfolio. I'm a little bit not worried, but I'm keeping an eye on my lower cash position. And actually, in the last couple of days, which you'll hear about the June update, I have taken some steps there. It's 4% cash. I mean, it's good to be fully invested in terms of markets have up days or stocks have up days. If one can benefit fully from that, then if situations arise where one needs to deploy money because something has become undervalued, you do need to have some cash about. 4%, yeah, we'd like that to be a couple of points higher potentially. The other change I made here is I split out commodities. So it's now commodities and crypto. So within the 3% that was there before, that did include some crypto, and that's now 1%. I want to keep that on a 1% cost basis actually, and then if it does something, it could end up as 5 or 10% of the portfolio. If it doesn't, then the downside is minimal. So, and in terms of the individual stocks, this includes my legacy 20,000 that I mentioned earlier, going back to 2013. As of the end of May, I was averaging 9.43% a year on the individual companies. So that's obviously well above my minimum targets over a long period of time. So that's great, and just a bit short of the stretch target. But that's improving because as of yesterday, it was over 10% with the change that happened in early June. So it's looking good on the kind of stock picking front. So the best performers overall as a total return, actually one of my more speculative positions, which was called Contura Energy. It's now Alpha Metallurgical Resources, which is a coal mining company, but it's not for coal for power. It's I think more coal for sort of steel and that sort of thing. And they're up 126%. So that is the top active stock that's in the portfolio. Investec Group, which is a bank, and I picked that one up last year. So I noticed the price to book was about 0.3 or so, and I looked into them and I thought, don't look like they're risk of failure. I quite like they look undervalued. And in the last month or so, it's really climbed up. So I'm almost in the 100% club on that one. That'd be great to add them in. Unilever, that was an 100% club. It's dropped back bits a couple of months ago before recovering, so it's almost back in the club. I've also seen more on K3 Capital in a minute, and I did buy my first tranche at about 160, 170. So it's over 100% that tranche. I averaged in as it went up. I was so confident in the business, and that's grown even further since the end of May. So they're the top ones, just to give you a bit of a flavour. And in terms of the overall biggest 5 stocks by value, it's the same 5 as last time. It's the same 5, you might call boring companies, but I quite like the boring companies. So Bank OZK up 10 points or so since last time. Had that in less than a year, so 60% return. Can't ask for too much more. Unum Group, I do like this company. About 40% return there, nice dividend, and it's also my eToro portfolio. Aviva, again, nice boring insurance company. They're consolidating their operations. They've been selling out business units that have been underperforming. They don't consider core. That's almost a 40% return. And I actually bought an initial tranche on that just over a year ago. And late last year, in fact, even at the start of this year, it may have been, I averaged in as it was going up. So that's why the compound annual growth rate is higher than the total return. K3 we just touched on, cracking company. Nobody's really heard of it. Almost up 80%. I think that's got further to go. I've actually done videos. I've done 3 on Bank OZK. I've done 1 on Aviva, and I've had K3 Capital and the 3 stocks to buy before. So these are all ones that you can put the links below for you. You can click on those and try and find out a bit more if you're interested. And then Unilever, that we mentioned as well, one of the first stocks I bought back in 2013. And you can see the difference between the capital and the total return is dividend. So dividend that's been dropping on Unilever has contributed to over 30 percentage points of that return. And it's been giving me a compound annual growth rate of 10% a year there since 2013, which is fantastic. And if you're UK based and you want to buy into these companies, I've got a free trade referral link in the description below. And if you're new to them, you can get a random share worth up to potentially £200. There's also got interactive brokers there if you're more international based. So do check that out if you're interested. That's the update on the £1 Million Challenge. Delighted with how it's going. I just want to try and continue to consolidate the portfolio in terms of trimming a couple of positions when I get good opportunities to, because I think I've still got a few too many stocks. I've had some questions in the comments on how do I keep up with so many stocks, and in actuality, some of them require closer monitoring. So let's say the more kind of growth stocks, the newer companies like TTCF, that I have to monitor much more actively and closely. Whereas some of the old, more sort of boring companies, Berkshire Hathaway's in a portfolio, for example, I don't really need to monitor that. I know what that's going to do. I'm totally confident in that company. There's nothing that's crazy that can happen to it. Try to get quite a few of these consistent companies because they actually require a lot less monitoring than a lot of the growth stocks. And then, yeah, the eToro has been a good start. So if you're interested in copy trading, check it out on eToro. The link is below. So thanks for watching. I look forward to catching you in the next one.